Hey y'all, I'm Allison Stitcher, CPA with Accounting Technology Solutions, and I help small business owners keep more money in their pocket. And I thought I'd start today by telling you a couple things about me personally. The best day of my life was the day my daughter was born. She is my light. I call her my angel baby. I feel like God sent her to me because my purpose here was to build her up and make her into a prosperous human being. The worst day of my life was the day my father died. I was a daddy's girl all my life, and when I was 21, he died. And it was the most devastating thing I've ever had happen in my life. And these two people are my motivation, the wind beneath my wings, if you can say, because I want to be an example to my daughter of what a strong woman should be like and should conduct herself as out in society, in business, in everything you do. And I know my daddy's looking at me from heaven. And every time he looks upon my face, I want him to be proud of the person he raised. Today, I chose to talk to you about your business structure and how that affects you and your taxes. And I've given you all handouts that kind of explain some little tidbits about the different types of business structures and how it affects you and your taxes. The first example of a business structure is a sole proprietorship. With a sole proprietorship, you and your business are one. There is no difference, there is no separation. You're taxed on the same tax form, and you're treated as if you are your business and your business is you. You pay self-employment taxes on your personal tax return for everything you earn. Some of the advantages are that you've got a lower tax rate than what most other companies pay. It's easy and quick. You only have one tax return to file. Disadvantages is there's no separation at all between you and your company. You are 100% liable for everything. And it's very hard to raise funding in that type of environment.
Amen.
A partnership is another entity, and this can be two or more people coming together to build a business. A partnership does file a separate return. It is a flow-through entity, meaning that the income flows from the partnership tax return to your personal tax return. It's easy to establish a partnership, and the taxes are pretty simple, but there's many disadvantages. And a partnership, you're not in control. It has to be a group decision about everything you do. And if you end up in some type of disagreement over a business decision, then it could pretty much dissolve your business, which is something that is quite typical in partnerships. An LLC is the next type of business entity. And an LLC offers you some of the advantages of being a corporation and some of the advantages of being a sole proprietorship at the same time. You have a choice in how you file your taxes, whether that goes to your personal tax return as a Schedule C, or whether you elect to be taxed as an S corp, or if there's more than one person in the business, then it's treated as a partnership. And those are all flow-through entities where things are going to flow from the business tax return to you personally. there is no way for you to create a salary for yourself. A lot of times in business, especially as you grow, you want to be able to pay yourself and pay payroll taxes. A lot of people struggle to pay quarterly estimates. They're not good at saving the money over the quarter so that they can submit larger amounts, or at the end of the year submit a large amount to pay the taxes that are going to be due for the business. And so being able to pay yourself a salary and essentially reduce your business income back down so that you're paying in regular tax payments is essential for a lot of businesses. And you cannot do that through a partnership. You have to do guaranteed payments to partners, and these are not taxed on the business level. They flow through and are taxed to you personally. And the way some of that works is that you get a credit from your adjusted gross income for a portion of those payroll taxes, but it does not reduce the tax liability dollar for dollar, because taxes are paid off of a percentage of the earnings. So there's several disadvantages there unless you elect to be taxed as an S corp. A C corp is a separate legal entity. It is one of the first corporate structures ever developed. You do have that complete separation, and you have limited your liability. You have the ability to generate capital. One of your problems is double taxation, because the income is taxed at the corporate level, and then when you take distributions from your company, you're taxed again. Finally, the S corp. This is the one I recommend to most of my clients. You have the corporate structure so that you have reduced your liability. You have the ability to pay yourself a salary, and you still have that flow through from the business to your personal tax return. I'm somebody that believes in educating my clients, and if you have any questions about how your business is structured, what that means tax-wise, or how to better help your business and yourself, please let me know. Again, Allison Stitcher, CPA, Accounting Technology Solutions.